On Monday, January 27, all of the semiconductor stocks took a major hit, from Intel, AMD, all the way to ASML, Broadcom, Marvell, Nvidia, and all the rest. These stocks went down quite heavily, some more than the others. It's not just them, it's the overall market that took a hit as well, but there were some stocks that were green. We did touch on that in the winners and losers video. If you missed that, that will be in the top right corner. Now, another company that took a major hit, that's Nebius. Now, we did touch on Nebius a couple of weeks ago, and now the stock is, well, back to under the price of my previous video at the start of the year. If you want to learn the whole backstory of Nebius, I highly suggest you go watch that. Otherwise, I'll just have to repeat myself over and over again. But Nebius did drop 37.4% on Monday. It actually dropped a little bit more than that as well, but it did close just above $26. Pre-market, a lot of the stocks that did get hit quite a lot on Monday are up already. So this one is up 3.2%, closing in on that $27 mark. So yeah, month over month, the stock is down 7%. Since it went back public on the stock market, the stock is up 30%. This is a company right now with a market cap of $6.14 billion and forward EV to sales of 8 times. This is a company that is expected to grow sales extremely quickly, as you can see right here, and as you will see from the presentation. It is not profitable yet, but from an adjusted EBITDA perspective, they expect to be profitable in 2025. Since the last time I covered this company, we now have one analyst here with a strong buy rating of $51.16, representing close to 100% upside from the price we're at right now. Now, why exactly did Nebius crash so much? Well, the fear is with DeepSeek is that, well, the majority of the Western companies have just over-invested, and if you can get results that are on par or performance on par with the ChatGPT o1 type of services without having to invest hundreds of millions, if not billions of dollars, then maybe companies like Nebius are going to take a hit. Companies like Nvidia and all of that also took a hit, but Nebius specifically went down 37%. It probably can also be explained by the fact that they're still not profitable. They're expecting to grow quite a lot, quite rapidly, because they do expect quite a lot of demand for GPUs. They're also buying more GPUs, so they need more computing power to serve the needs of the customers. But if you do not need that much computing power, what does that do to a business like Nebius? Well, I'm glad you asked. I'm glad I'm asking that to myself because there's nobody here, but we're going to discuss that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment, get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So a quick recap of the Nebius business. So Nebius Group, they're building a global AI business which integrates essential components for successful AI development, infrastructure, data, and expertise. Nebius cloud revenue surged 2.7 times quarter over quarter, almost 8x year over year against the low base, with ARR surpassing $120 million. Now, when you buy Nebius stock, you get all of this, but like I said in the last video, this part right here, the core Nebius business, is 2/3 of their revenue. All of this here, let's call that a call option. So Nebius, the core business, is an AI-centric cloud platform built for intensive AI and ML workloads, featuring both owned and co-location data center capacity with ongoing expansion. As you can see right here, Nebius Group is growing extremely rapidly, whether it's revenue or ARR. They have some key competitive advantages, which they note right here. So, sole focus on AI architecture, allowing them to provide solutions precisely tailored to meet the specific needs of AI developers and businesses. They have also a long-standing collaboration with NVIDIA. Nebius will be one of the first providers in Europe to bring the state-of-the-art energy-efficient NVIDIA Blackwell platform to customers in 2025. The fact that this is a European player should not be seen as a negative, but as a positive. They also said the following: they have full control over the whole AI infrastructure value creation chain, from in-house server designs to proprietary cloud platform, ensuring maximum productivity and quick scaling, higher cost efficiency, and low downtime. And this is very important. This is how they differentiate themselves to others. And this is also, let's say, a small comparison to what DeepSeek is managing to do, right? managing to have around the same performance as some leading American solutions, but at a fraction of the price. So they say here 20 to 25% lower total cost of GPU ownership and operations compared to an average GPU provider. They also have long-term relations and collaborations experience with leading service ODMs for co-designing, manufacturing, and optimizing cost structure on servers. And don't forget, this is an experienced team, right? Yandex, the Google of Russia, was not just a small company that nobody knew about and was worth nothing. No, it was a giant. Yes, it was a Russian company, but the team here at Nebius, first of all, the team is, well, the HQ is in Amsterdam right now, fully divested from Russia. So you're buying here a European company, but the team behind it is a highly experienced, highly skilled one as well. Very, very focused on making sure that they are extremely competitive on all fronts. With regards to some projections and some updates, they did tell us that 2025 ARR, the guidance has been updated a little bit. The low end went from $500 million to $750 million, while the high end stays at $1 billion, which again still represents a significant amount of upside. They also said the following, that for 2024, they expect ARR to come between $170 to $190 million. Revenue goes from, well, Q3 2024 of $27 million. The whole year will be around $70 to $80 million. CapEx is still going to increase quite significantly, but they do have the cash. It's this plus the 700 and something million that they did raise not so long ago. They also expect to become adjusted EBITDA positive for the full year 2025. Nebius is also not just a one-trick pony. These are all the solutions that they offer. Not going to go over them one by one, but they have data preparation, model training, machine learning, inference, etc., etc. So very, very solutions. And again, this is going to become a one-stop shop. And all of that is nice, right? All of that is nice. You're now investing in this company because of the growth story. Of course, it's a growth story, which means execution is key, because it's always nice to see, oh, we're going to invest XYZ billions of dollars in this. We expect XYZ % of increase in revenue, tralala, tralala. Okay, great. But this is a growth story, which means you have to follow that story, because if they do not meet their low or high end of their guidance, if they do still increase CapEx that much, then there's going to be some issues here. And now coming in with DeepSeek's revelation and solution, that definitely could hurt a company like Nebius, and I'll explain. Now, I'm still on the camp of, okay, great, DeepSeek, good solution. I don't know if your numbers are 100% correct, but the direction that this is going makes sense, okay? Makes sense. Now, with regards to Nebius, a 50% reduction in compute per model could theoretically have Nebius revenue from GPU rentals, right? It makes sense. Now, this, by the way, is their pricing that you can see on their websites, which again is highly, highly competitive. But yes, it's true. If hypothetically, if there is a 50% reduction in compute per model, that could definitely well have Nebius revenue from GPU rentals. Now, I'll go back to what this smart guy here said on X. Cheaper gasoline doesn't reduce oil demand if it leads to more drivers on the road. And so, and by the way, this is me, haha, funny joke. Anyways, I wrote the following here. Lower cost of AI development will lead to more users to build, which then will lead to an increased total GPU demand. So let's say you have 100 users paying you $10. Now, you can have, let's say, 1,000 users paying you $1, which is about the same, right? Exactly the same. But what if you can make it so that there are 1,000 users paying you $2? The $2 is of course less than the $10 that you charged before, but now you have 1,000 users and not just 100. You see where I'm going with this? You can then have, of course, mass scale inference, which would be good for companies like AMD. And then, of course, not all workloads are equal. There is this thing called AI distillation, which is basically using bigger models like a future GPT-5, Llama 4, Grok 3, 4, whatever, to train smaller models like DeepSeek, more specialized models. So with the bigger ones, with the bigger models, those will still need to use high-end GPUs, and those definitely will be more expensive. But yes, the lower end models could definitely be done with less resources and should cost you way less. But again, if a lower cost of AI development could lead you to more users to build, which will lead you to an increased total GPU demand, what's the problem here? And that's the thing. There is no problem. There is no problem. We've seen that with past technologies as well. It starts off as something expensive, exclusive to a part of the society, of a population, of companies, whatnot. And then as that thing becomes cheaper and cheaper, it becomes highly available throughout society. That doesn't mean that there is no money to be made. No, on the contrary, there's way more money to be made because it becomes widely available. Now, the money is not in the LLMs, right? We've known this for quite a while. Palantir has been talking about this for quite a while as well. LLMs are becoming a commodity, but it's not the LLM. The thing here is they call it the GPT wrappers with a W, right? It's what you build on top of it. It's the product that you build thanks to LLMs, right? Thanks to LLMs, it's not just one LLM, you can use whatever. It doesn't really matter. Optionality is out there, doesn't matter. But it's the platform, it's the distribution, it's your solution that you're offering a user. That's what makes your business special, and that's your, let's call it, competitive advantage. Your competitive advantage is not, oh, I'm using Claude, or no, nobody cares. Nobody cares because eventually it will all be the same, and probably every platform will offer the solution or the option to use whatever LLM you want to use. But the thing is what you do with that LLM. It's what you do with the data that you have or that comes in and out, and how you manipulate that and all of that, the solutions that you provide. That's the whole thing here. So on Monday, yes, I do think it was a buy the dip type of opportunity for a lot of the companies. There are some companies that just went up quite a lot and needed to come down a little bit, and this definitely helped push the first domino. So, okay. Plus, we have earnings season, so I do expect all of the big tech companies to talk about DeepSeek, CapEx spending, and all of that during their earnings call. There will for sure be a lot of questions from analysts. And so right now, if we look at the stock, we can see that huge red candle from Monday. We actually went back into that small gap that was created at the start of December 2024. Didn't completely get filled, but fine. Right now I can see pre-market, we're actually going a little bit higher, back above $27, which is where the stock has been back here in mid of December for a week or two. Now I'll conclude by saying the same thing I said in my first Nebius video. I think this company is still flying under the radar. I still have not opened a position because, well, the stock did go higher and higher and higher. And now you're going to say, yeah, but it dropped quite a lot, so why not open? Well, unfortunately, I did add to companies like Micron, so don't have a limited amount of cash. Plus, I do want to keep some cash on the side, especially as we go into this earnings season. But definitely the price does look way more attractive right now than it did a couple of days ago. So that's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.